Perfect. I'll prepare a 600-word detailed thematic summary structured into 4 chapters, highlighting the book's key ideas on risk management techniques and trading strategies. Summary of risk management in trading. Chapter 1. Foundations of risk and trading organizations. Risk in trading is not inherently negative. It reflects uncertainty and the scale of potential gains or losses. Professional trading groups such as hedge funds and proprietary trading desks thrive by balancing risk with reward. Unlike mutual funds, hedge funds and trading desks exploit leverage and short selling to profit in both rising and falling markets. Hedge funds operate as private partnerships with general partners managing trades and limited partners supplying capital. Their flexible structures allow them to pursue complex strategies with fewer restrictions, catering to accredited investors who meet high financial thresholds. Trading desks function as specialized teams within financial firms, handling specific markets like equities, bonds, or commodities. Each desk is further divided into strategies, systematic methods traders use to capture opportunities, global macro betting on economic trends using indices, bonds, and currencies, relative value, exploiting price spreads between assets, often in market-neutral formats, event-driven trading around corporate events like mergers or spin-offs. These organizations depend on risk management to survive in competitive markets. Managing capital allocation, setting position limits, and structuring hedges are core tools to keep risk in proportion to expected returns. Chapter 2. Core Risk Management Techniques. The book identifies 4 categories of risk management decisions. 1. Avoidance, exiting markets or opportunities where risks outweigh advantages. 2. Control, setting daily mark-to-market practices, position limits, and monitoring P&L. 3. Transfer hedging or buying insurance to shift risk to others at a cost. 4. Acceptance, taking risks deliberately with clear budgeting for potential losses. Practical tools reinforce these decisions. Backtesting and trade forensics, testing strategies on historical data before committing capital, and analyzing trade outcomes after execution. Mark-to-market daily revaluation of positions to reflect current market prices, ensuring transparency of gains or losses. Value at risk, VAR, statistical modeling to estimate maximum losses under normal conditions, enabling firms to set uniform exposure limits. Hedging, offsetting exposures with derivatives or contracts to reduce downside. Options and Greeks, measuring sensitivity of option positions, delta, gamma, vega, to control nonlinear risks. Credit value adjustments, CVA, adjusting for counterparty default risk when trades extend into the future. Together, these techniques allow traders not only to measure risk but to translate analysis into actionable limits and strategies that keep trading businesses solvent. Chapter 3. Risk in Practice, Decision-Making and Strategies. Risk management is valuable only if it drives real decisions. Edwards stresses that bloated reports or complex metrics are useless unless they lead to actions such as resizing positions or hedging exposures. Capital allocation. Traders decide how much to commit to each strategy based on risk-adjusted returns rather than raw profit potential. Position limits. Controlling the size of exposure relative to volatility ensures that no single trade jeopardizes the portfolio. Hedging applications. Airlines hedge fuel costs and commodity traders use forwards and futures to stabilize earnings. Credit risk management. Since trades often involve future obligations, assessing counterparties is critical. Collateral requirements, margin calls, and CVA ensure protection against defaults. A key insight is that risk management itself can be risky. Poorly designed hedges or misinterpreted metrics can create losses larger than speculative trades. Therefore, oversight and understanding of details remain essential. Strategies like global macro, relative value, and event-driven rely heavily on these risk management frameworks. For instance, relative value funds must carefully hedge market exposure to isolate spreads, while macro funds depend on scenario modeling to anticipate turning points in economic cycles. Chapter 4. Broader Themes and Lessons. The book emphasizes 3 recurring themes. 1. Risk is not always bad, it is a measure of scale, not morality. Large investments carry greater risks simply due to their size, even if fundamentally sound. 2. Details matter. Simplifying risks for decision-making is necessary, but excessive abstraction can hide dangers. Human oversight remains indispensable. 3. Risk management is both art and science. Mathematics provides tools like VR or option Greeks, but judgment, intuition, and market experience determine success. Finally, the book distinguishes speculation versus gambling. Speculation assumes significant risk with skill and analysis to achieve profits, while gambling relies on chance. Hedge funds succeed by applying disciplined risk management to speculation, not luck. By integrating systematic controls, aligning analysis with decisions, and applying strategies suited to their strengths, hedge funds and trading desks can thrive in volatile markets. The message is clear. Effective risk management is not about eliminating risk, but about structuring it into profitable opportunity.